In today's video, I'm going to tell you exactly why we're no longer investing in the Ontario market. And after watching this video in full, you're going to understand the full reason why and understand the shift in strategy and mindset towards why we're no longer investing in this market and heading over to the US market. And it's all going to begin right after this. Hi everyone, Josh Tavares, investor and realtor at eXp Realty. It'd be so great if you can help us out and hit the like button, hit the subscribe button, and hit the notification bell to get updates on our newly uploaded content. And if you're looking to invest in real estate, hands off, great cash flow, great appreciation with very low price point, click the link below. Let's book an appointment and get you started on your way. And without further ado, everybody, let's begin. And the first reason why we're no longer investing in the Ontario market is the high price point. Now, the last couple of years, economic fundamentals have been so strong that what's ends up happening is the properties have gone up so much, making it hard to cash flow with these properties, whether they're single family homes, duplexes, triplexes, even multifamily, and the prices have substantially increased over the last 10 years. Now let's look at the Hamilton market, a great fundamental area that's got great properties at a pretty high price point. Let's say for a duplex, you're going to be looking at $950,000, and you're going to be looking at rental rates at about $4,000, which is pretty decent. But when you look at all the expenses, it's going to be really challenging to cash flow. Now, all these type of properties, because the price point is so high, you have to have a high income and a high down payment. Where with the down payment alone, you'd be able to purchase about 2 to 3 properties full in cash flowing about $500 to $700 in USD. That can actually replace most of your income, in which just with those few properties alone, you'd be able to duplicate within 6 to 12 months time and scale your portfolio from, let's say, about 3 properties to about 6 properties. Purchasing 6 properties in Southern Ontario with a similar magnitude that we're looking here in Hamilton would probably cost you close to about $6 to $7 million in Canadian. Now, with money like that, who's going to invest that into duplexes and triplexes? You're better off just invest that money into multifamily if you have that kind of money. Now, unfortunately, most investors are more like mom and pop investors and don't have that kind of money to purchase that much property for that price tag. Now, even going as far as Thunder Bay and Sudbury, you're still going to be paying about $300,000 in Canadian, where is going to be the cheapest that you're going to be able to obtain in the Ontario market. Now, I know Ontario has strong economic fundamentals, but some of these other cities in the US have really strong fundamentals. For a fraction of the price that you'd be able to pay in, let's say, the Thunder Bay market, you could have bought a couple of properties full in cash and be able to cash flow within multiple properties about $1,200 between 2 to 3 properties. That's a massive game changer when you look at all the expenses you're going to incur in the Ontario market, that you're probably going to be left with a couple $100 in cash flow depending on the down payment that you invested into those properties. Number 2 on this list is the landlord tenant board rules. Now, with being an investor in Ontario, I will say the fundamentals have been so good that you've been able to receive exponential amount of returns. So if you're someone who invested about 10 years ago, you've probably seen your properties go from about a couple $100,000 in value to closer on the $1 million side, depending on what type of property and where you're investing. As any investor has seen in the last 5 to 10 years, there's been fantastic gains. However, alongside with those type of positives, you're going to come with the negatives alongside with the landlord tenant board rules that are more favored towards tenants. And their investors who have very savvy tenants who understand the rules, have found ways to not pay rent from 6 to 12 months and taking that much of a time frame to have them removed. And that can cost an investor anywhere between $30,000 and $50,000 in income. And most investors don't have a big pocket full of funds waiting to spend on anything as such. They're going to have to take out funds from a line of credit, maybe credit cards, savings, anything as such in order to pay those expenses. And remember, most investors are not rich by any means. They have a couple of properties that's going to lead to a great financial retirement or even something to hand off to their family. They're not creating cash flow of like $5,000 to $10,000 every month unless they're in the multifamily space. So being an investor in Ontario, you have to be super prudent, and there's a lot of different ways that the tenants have the ability to find ways to benefit from that investors don't necessarily have. Now, in the US market, there are many different cities, and especially in states, where if a tenant is not able to pay in full within a certain time frame, much shorter time frame, then guess what? The paperwork will get processed much quicker, and the eviction will take place much quicker, with the sheriff having the tenants being removed usually within 3 to 6 months. Now, that's much better than we've seen here in the Ontario market. Now, I've spoken to many different investors who invest in the US, and they have said that it takes a very little time, especially investors who invested on the Canadian side. didn't have the greatest experience, went over to the US side and said that there's very little times where they have tenants ever abusing the system, and very little times that they actually end up staying in the property for a very long time, which is fantastic for your investment because, like I already had stated, most investors do not have a ton of cash to pay for those expenses. However, it's super important no matter where you invest that you understand the landlord and tenant board rules, and you work alongside with other investors and people on your team who understand the rule and who are investors, because it's very important. Even with property management, we said with countless other videos, even though you have someone managing your properties, you still want to be educated of the rules so you can make an educated decision if a circumstance takes place. Number 3 on our list, and it's a big one, is low rental rate increases. For rent increases, we typically see about 2 to 2.5%, but the last couple of years, because of the pandemic taking place, we've actually seen less than 2% and more than 1.5%. And at one point, we weren't even able to increase rents for about a full year. And with the cost of inflation taking place and everything as such, especially for investors who had tenants who weren't paying either in full or even on time, that was a big stress on those investors. And to be honest, 2% is literally just to keep your portfolio up with cost of living, which, as we've seen, the cost of living has been closer to 7 to 10%. So even getting 2% now, as we've seen in Ontario, it's about 2 to 2.5%, you're still losing about 5 to 7% annually with inflation. This is a big issue for investors. It's becoming harder and harder, especially in the Southern Ontario market, even though prices continue to increase. However, if you have tenants who stay for a very long time, it becomes harder with all the expenses taking place to be able to capitalize and have a good cash flow increasing year over year. Now, if you do have tenants that are leaving every other year, it's not too bad. But if you have long-term tenants who are staying 5+ years, it becomes very challenging to get up to date with current market trends. And for those of you who've seen tenants come and go, you've seen how much the rents have increased, multiple hundreds of dollars per month. I'm seeing investors who've had tenants in the same property for about 5 years. Once they leave and rent it out to a new tenant, they're seeing anywhere from $350 to about $600 increase per month. That's a massive increase in revenue and can really help in the future in terms of refinancing and scaling your portfolio. Now, when we're investing in the US market in Detroit, you essentially can raise the rents however you like. However, you of course don't want to go too high, or it's going to be really challenging to get really good tenants because they're going to get scared off and go where there's going to be lower rental rates. Especially if you have really good tenants who are taking care of your property, paid in full, on time, you don't want to increase too much. You want to essentially go with cost of living, especially if those tenants are in workplaces where maybe their raises are going to be closer towards cost of living and not try to go above and beyond. And that's why it's really important to get up to date on market trends as to what current rents are going for places like PadMapper. That'll give you an idea as to what rents are going for that particular unit or that particular property type. As an investor, it's always important to be on your A game and not be complacent and understand what's going on with the market, whether it's increasing rents or decreasing expenses, because that could be the difference in building more wealth and the ability to generate more income that you can use to refinance and build your portfolio further. Number 4, this next one is a big one, and it's low cash flow. Everything taking place in the Ontario market with how expensive properties are, you're seeing very little cash flow. That's after everything's said and done, including mortgage, property tax, insurance, utilities, and any other expenses you have on the property. Now think of it this way: if you purchase a property for about $950,000 in the Hamilton region, you're expecting to get a decent return. However, you're going to be stuck with about $100, maybe $200 in cash flow, depending on the down payment you have in place. And it's also going to be a factor in terms of the amount of rents. If you're purchasing a property for, let's say, about $950, but you're still getting about, let's say, 2018's rents, then guess what? That $200 in cash flow might actually be closer towards maybe like $25, $50 a month. And like I said before, that could be a massive difference come down the road. Now in the Detroit market they're going after, we got single family homes, and with that's so great is that we have the tenants paying for the utilities. And because the price points are so low, we're purchasing the property in full cash, so there's no mortgage on the property, at least initially. So then at a later point we can refinance, purchase more properties with great cash flow. We're seeing cash flows between $500 to $700 in USD, which is closer towards $800 to $900 in Canadian. And after about 5 or so properties, you're going to be looking at enough income, depending on what your income is, to replace your income and just be a real estate investor. And to me, that's much better than working a 9-to-5 job, having your portfolio build wealth and generate income for you on a monthly basis. Number 5, hard to scale your portfolio. Now in Ontario, not only how expensive properties have gotten, but also how prudent the lending institutions have become, it's becoming harder and harder to scale depending on your income, down payment, and your credit score. There are many different investors who have a great reputation with the banks, great credit score, great income. However, based on the many different mortgages they have, the lending institutions here in Canada are saying, no way, we completely love what you've done with your portfolio, but we can't afford to give you any more financing. Which is why there are so many different investors going about creative financing solutions or going about the joint venture route. Now, it's fantastic that the Canadian lending institutions are very prudent. However, that makes it very hard as an investor to scale your portfolio and get closer towards your dreams with your family. Now in the US market, I will say, being a foreign national, depending on the route in terms of the financing institution you're going to use and the way you go about acquiring your first property, there can be some limitations to some degree. However, we're working with a lending institution who strictly works with investor foreign nationals that has very creative financing options that gives you the ability to purchase the first property full in cash within 6 to 12 months, be able to refinance that property and purchase a couple more. In Ontario, good luck with that. For most people, let's just say you go into an area that's even cheaper in Hamilton. Let's say in St. Catharines, about $750,000. Unless you have a really great income, exceptional credit score, and a great down payment, it's going to be really hard to purchase one property for about $750 and be able to scale right away. You're probably going to have to wait about 5 to 6 years to be able to refinance and purchase anything else. And to be honest, who knows what those $750,000 properties will be worth in that time. They could be worth 1.2, 1.3 by then. And at that point, it's going to be so challenging to be able to buy even more property. You may only be stuck with the one property you purchased for $750 and pretty much be done with it. And that's why so many investors get in with big dreams and aspirations. And once the lending institutions come and crack everything down and say, hey, guess what? You can't purchase any more properties, they essentially just say sure, and they're happy with what they have instead of finding unique ways to go about building and scaling their real estate portfolio. Number 8, this is the second last one on this list, is higher insurance premium. Since we've become investors, we've had the same insurance company, and starting out the first few years, insurance coverage was great, prices were reasonable, and they had great coverage. Unfortunately, our insurance providers in Western Canada, and there's been a lot of claims, so because of that, we've seen our insurance premiums actually double in price. We were looking on average about $3,000 Canadian per property to insure for a full year. That's a really high price tag, even with everything they provide in terms of backflow prevention, fire, loss of income, and everything as such for an investor to take on, especially with the cost of living going up so high and rents only going up about 2%, even less the last couple of years in rental increases. Now, there are different insurance providers with lower costs. However, they're going to provide you less in value or become even harder to obtain the funds in the event that something does take place. This is concerning because that's just adding on to the expenses and making it even harder for any investor in the Ontario market to cash flow. Now, on the insurance side, with our single family properties, we've been able to get insurance so low that annually it's about $700 and it covers all the big things. So then this way we can live peacefully in the event that something was to take place. It's costing us less and we'll be able to obtain the funds easier in the event that something did take place. As an investor, especially an investor on the Canadian side investing in the US side, it makes us help sleep easier at night. Last but not least, this is a big one. And if you're not able to do this, then guess what? You won't be able to be an investor. And this is finding good deals. As a real estate investor, the biggest thing is finding the deal. Without the deal, you don't have a property, you're not an investor. And it's becoming very, very challenging based on all of the numbers and everything taking place the last 5 to 10 years, especially the last couple of years of the pandemic, becomes very challenging to find a good deal. Given everything that's taken place the last couple of years, it becomes more and more challenging to find a great deal, whether you're going turnkey, BRRRR method, anything as such. In 2018, when we began investing, it took a couple of months to find the good deals that we were looking for the cash flow and appreciation that we sought after. Now with everything's taking place with the high appreciation, expenses, cost of living, it's going to take you double that time to find one good deal. Now, there are many different wholesalers out there that are going to provide you access to deals, but the question is, not all the wholesalers are going to find you the right property that's going to cash flow at the right place if you're an investor looking for a buy and hold. Now, if you're looking for a quick fix and flip, that's more of a benefit on your end. But if you're an investor looking to purchase and have cash flow from day one and go on, there can be some challenges there. Now, I will say there are some great wholesalers that are able to find excellent deals based on the communities that they're serving, that they're able to find properties that are super low, that if you get in quick enough, you'll be able to see great cash flow appreciation and really help scale your portfolio from there. Now with the US market, there's so many different areas that have a low price point, that have decent rents, that you'll be able to find properties within the 1% rule. The 1% rule is having rents being 1% or even higher than what the actual sales price of the property is. In Ontario, no longer exists. That duplex I was talking about in Hamilton costing you $950,000, you're going to need to generate about $9,500 in monthly income. That property is more likely to get you about $4,000, maybe a little bit more in income, and nowhere near $9,500. So guess what? The opportunity of cash flow in Ontario market, like I said earlier, is even lower. Or like I said in the US, way more properties are out there that you'll be able to cash flow considerably because of the 1% rule, making it so much easier to cash flow anywhere from $400 to $800 in USD. And like I said, if you've got about 5 of those properties in your portfolio, for most people or many people, you're probably not going to need to work your 9-to-5 job if that's the cash flow that you're averaging every month. And with many of these cities that have great fundamentals taking place, it becomes so much easier to find deals because there are a lot more inventory for homes, and there's a lot more wholesalers that find great deals that you'll be able to find properties in that 1% range we spoke about. Deal flow is super important, and if you're not seeing enough properties come your way that make sense financially, guess what? It's going to be really, really hard for you to go about building a portfolio very quickly. And this is something that we're in our growth phase that we're looking to achieve as we speak. In Ontario, there's very limited inventory to find that actually makes sense for investors, taking a very long time to find one good deal. Where in this market that we're actually investing in, there's a lot more inventory, less than what there used to be about 5 years ago, but still more than you'd see right now in Ontario for deals that make sense for cash flow, appreciation, and having the ability to scale further. Thanks for watching, everyone. I hope that video was super helpful, insightful, and gives you all the information as to why we're not investing in Ontario anymore and sticking more on the US side. I'm Josh Tavares, investor and realtor at the eXp Realty. And if you're looking to partner and purchase great properties at a low price point, great cash flow, excellent appreciation, book a time with us, and we're super looking forward to get on a call and partnering with you in the very near future. And remember, help us out and hit the like button, hit the subscribe button, hit the notification bell to get updates on our newly uploaded content. Thanks so much for watching. Take care.